A housing crisis of historic proportions occurred in the United States between 2006 and 2012, the worst downturn since the Great Depression. This was not only a local disaster, it had worldwide effects as well, causing a deep recession that extended beyond the boundaries of the United States. Though debates, reviews, films, and documentaries frequently center on the 2008 financial crisis, one important aspect of these discussions is often overlooked: the years preceding the crash, now referred to as the bubble era. The bubble era between 2002 and 2012 witnessed a gradual but relentless increase in U.S. housing values, creating an environment akin to a modern-day gold rush. Real estate emerged as the epicenter of a feverish pursuit, with prices escalating daily. However, this upward trajectory left potential homebuyers unsatisfied, confused, and sometimes infuriated. This story might sound eerily familiar, as the real estate market has seen prices steadily rise again since the crash in 2012, only to erupt in the face of unprecedented events in 2020. Charlie Munger warned of an impending storm in the U.S. commercial real estate market. Munger voiced worries about bad loans weighing American banks down as real estate values fall. Naturally, this raises concerns about the extent of possible losses and the industries or geographical areas that are most at risk. If you've stayed engaged with this video, it indicates a serious commitment to understanding your financial landscape. But before we start, make sure to subscribe to our channel, Financial Freedom, and press the bell icon to stay in touch. And most importantly, if you have any questions or are seeking help, email us. Let's start the video. Real estate realities. Before the disastrous tragedy that changed the financial landscape, various voices beyond Hollywood portrayals warned of an imminent housing market disaster. Unlike the movie story, several wise individuals, prominent investors, and common people recognized the impending disaster. Often regarded as the world's finest investor, Warren Buffett was one of the few who saw the market's vulnerability. One memorable event was when Buffett openly discussed worries about residential real estate at the 2006 Berkshire annual meeting, pointing out how unstable the market was. His observations from that era reveal a disturbing parallel to the status of the American real estate market today. Buffett delineated the risks and accurately identified the dangerous combination of high leverage and greed among speculative real estate investors, a concoction destined for implosion. Buffett drew attention to the historical pattern of property value swings, citing instances in New York over the last 30 years. His observations underscore the cyclical nature of real estate, where even prime locations witness significant fluctuations. The slowdown, evident across various states, is particularly pronounced in once red-hot markets, especially in the high-end segment, a sector vulnerable to substantial corrections. Real estate speculation. Under the guise of speculation, the real estate landscape has transformed into a realm where misguided ventures and imprudent leveraging have taken center stage. Rather than viewing a home as a sanctuary and an investment in stable living, many have steered towards using substantial sums, like $100,000, to acquire properties valued at $270,000, anchored by mortgages. The mantra seems to be resilience. As long as individuals retain jobs and familial bonds remain intact, the immediate impact of fluctuating market values may seem minimal. However, Warren Buffett highlights a darker undercurrent, a surge in speculative holdings reminiscent of the day trading fervor seen in the penny stock market. The past 2 years have witnessed an unprecedented surge in investment activity, marked by a disturbing trend of investors resorting to undisclosed speculative fundraising methods. This surge includes a mix of risky and fraudulent loans indicative of a market veering towards dangerous territory. Consider this analogous to the frenzy of day trading in the Internet era, a market that can swiftly halt and then unpredictably reopen, leading to substantial disruptions. The line between stable home ownership and speculative endeavors blurs as the market becomes a playground for those seeking quick profits rather than enduring value. Warren Buffett's cautionary narrative underscores the need to reevaluate how we perceive and engage with real estate. The essence lies not in the immediate gains or losses, but in the sustained stability and long-term value that responsible investment practices can bring. As families and individuals navigate the complex real estate market, Buffett's words serve as a guiding beacon, urging a return to fundamentals and a departure from the speculative excesses that threaten the foundation of stable home ownership. House crises. As Warren Buffett aptly describes, the real estate market operates under the principle of the law of vital few, revealing its distinct dynamics compared to the stock market. Unlike stocks that undergo daily scrutiny on live markets, real estate transactions hinge on comparable, drawn from a limited pool of transactions, creating an environment ripe for significant valuation swings. Buffett denounces the prevalent practice of estimating home values based on a single comparable sale, emphasizing its susceptibility to drastic fluctuations. A neighborhood's worth, he contends, can be swiftly redefined by a few unfavorable transactions, sparking unforeseen collapses. This phenomenon is particularly evident when investors, buoyed by optimism, rely on just one buyer willing to meet their pricing expectations. The ripple effect keeps the neighborhood afloat, but the descent is precipitous once news of the decline spreads, prompting a frantic rush to exit the market. Daily life offers a tangible example in Phoenix during the 2008 housing crisis. Property values plummeted by more than 5% in a month, translating to a staggering $115,000 loss on a $300,000 house. The average property witnessed a 37% erosion of its value in a year. This stark downturn wasn't exclusive to the metro average. Individual areas experienced severe depreciation, with homes losing over 60% of their value in a year. The real estate market's propensity for bubble-like behavior, marked by soaring prices followed by precipitous crashes, underscores the importance of understanding its nuances. Buffett's insights illuminate the risks inherent in relying on a few transactions to gauge an entire market. As homeowners and investors navigate this roller coaster, the law of vital few lesson resonates. A comprehensive understanding of real estate dynamics is crucial to weather the highs and lows and secure long-term stability. Lessons from Buffett and Munger. The Berkshire Conference, which featured Warren Buffett and Charlie Munger, presented excellent insights into the current situation of housing finance and its potential ramifications, reminiscent of previous scenarios in the manufactured housing sector. Both experts highlighted the inherent risks that could result in a replay of previous financial crises and cautioned about the concerning extension of credit in the housing sector. Buffett highlighted the negative effects of dumb lending, drawing comparisons between current affairs and earlier recessions. He likened it to an illness that goes undetected until it shows symptoms, frequently leading to a financial crisis. Speculative investments tend to promote unsustainable expansion, and the reflections on historical events, like the savings and loan crisis, highlighted the cyclical character of financial markets. In conclusion, Buffett and Munger's insights are a timely warning for investors and homeowners alike. As the housing market exhibits familiar patterns, it's essential to approach financial decisions with caution, acknowledging the potential pitfalls and preparing for the uncertainties that may lie ahead. If you have any questions or seek further guidance, email us. By pressing the bell icon, ensure you're updated by subscribing to our channel, Financial Freedom. Don't keep this valuable information to yourself. Share it with friends seeking financial wisdom.